Welcome to Hedgeye NexGen, where we will be breaking down finance to its simplest form to help you build wealth. I'm Ryan Ricci, by the way. I'm joined by my co-host here, Ben Perko.
Hey guys, I'm Ben. I'm on the media team here. And why don't we start off, Ryan, a little bit about yourself. Who are you? Where you come from? Earth, I assume.
It is Earth. It is this planet. So my name's Ryan.
Yeah.
Okay, I'm a macro analyst here at Hedgeye. So basically what we do is we give out research in terms of like more market-based research. I do macro, which basically means I cover a lot of things, but it's mostly just kind of like where is the global economy? Where is it going? And maybe where are the risks to the overall global economy? That's the big picture of who I am and what I do. Been here maybe like 3 or so years. I think I do a good job. People say I do a good job sometimes. So
you do a good job at blowing up computers. That's for sure.
I also do a lot of coding, and so I actually build AI algorithms too. Pretty cool. Not gonna lie, definitely helped me get one girl.
There you go.
The wife.
Newly married.
Newly married.
And just a little bit about your background. Like, where'd you go to school?
Sure.
What'd you study?
Sure. So I studied finance. I had 2 minors in economics and I think computer science. And so I don't know a little bit about that. I went to Bentley University, pretty cool school. It was top 10 in the Wall Street Journal for Business at one point in time, 2015 or so. Really?
Good hockey team.
I
don't know if you ever got out of the library to go to a game, but...
Oh, no. So I actually lived on the floor with all the freshman hockey kids.
Oh, yeah.
In my freshman year. And so I knew all of them. And then I actually also played in the band for every single hockey game. So I know the hockey kids there pretty well. But we were on the come up because we basically had an awful arena. We basically played in a middle school arena. So bad that most hockey people would not, like other teams wouldn't play us in our arena, and then they built a new one, and so I'm sure
it's a nice rink.
It's a sick rink.
Yeah, it's a sick rink.
It's really nice rink. So yeah.
Anyways,
that's I guess, but yeah, that's about where I came from. I know golfing pretty well too. I was a caddy for 10 years.
And a good golfer. I can attest to that.
I give myself an average. I'm a better caddy. I think.
You do. You're good at reading the line.
I can read the green, and then the swing. I mean, I'd have to get outside a little bit more to get better at that.
I would say better than all that, though, you're an excellent macro analyst, and that's why we're here to talk about the economy, investing. But this is Hedgeye NexGen, so we're talking more to the new age of investors, how to get people in, what beginner tips people need to properly do this, so you don't make a bunch of mistakes. Right?
Exactly, and we're probably like not even talk about the market ever, really, like in terms of like where is S&P in that. We are probably not even going to touch that one bit. We have a lot of other stuff. If you want to see that here, we are just going to talk about really just hopefully the most basics of finance.
Yeah, and I think starting out super basic. I know this is a question I've had before, so we'll start saving versus investing. I mean, you hear about high yield saving accounts. You hear about just keeping money in your bank account, and then you hear about investing in the stock market, which goes into all different sorts of loopholes and strategies. What are the differences? What are the pros and cons to saving versus investing? And obviously they're not the same thing, but can you explain a little bit about the differences?
I would say they're not the same thing. I agree with you completely on that. I'd say saving and invest. So saving is like, I think of it as like a literal savings account. Like you go to your bank. I want to open a savings account. Right. And then you put money in there, and they're like, okay, here's the rate of return we're going to give you. It's 0.00001%. And so even if you put $1 million, at the end of the year, you get 1 penny off. So literally nothing.
Not a good deal.
So I would say that's what savings is, and I would say that has its place. We'll describe the difference. And then investing is more, okay, I have this money, this spare money, where like I'm going to put it into something called the market, and we can talk what that is, but just put it in somewhere, and then it grows. Maybe it grows at 10%, 5%, 20%. Maybe it could shrink. Yeah, that too. And so I would say that's what investing is versus savings. Now, what would I say about the different, like what each one is I'll be honest, I actually don't even have a savings account.
No. Well,
fun fact. So because here's the thought process here, right? So a savings account gets 0.001% or so, right?
Yeah.
Basically nothing.
The traditional savings.
The traditional savings account, yeah. where like you can go and if you let's say you open a brokerage account, right?
Yep.
They have vehicles and they're basically the risk free. Nothing's risk free in life, but this is as close to risk free as you can get.
As in, like, if the market goes down, you won't lose money in this risk free rate.
Yes.
That they give you.
Yeah, exactly. And that rate right now is about 4 to 5%, depending on where you go. That means so like you put your money in, and then in a year you'll have 4 to 5% more money. So to me, I'm like, okay, I can either get 0% or I can get 4 to 5%. I'm going to take this 4 to 5% every single day of the week.
Sounds
right?
like a no-brainer.
And so that's what I do for that part. But then in terms of investing is I actually I just take the S&P 500. So that's okay. S&P 500 is basically it's 500 U.S. companies. It's what people would call the market. If they're saying I'm investing in the market, like your index is the S&P 500. And so what like a manager or like a professional would try to be doing is beat the S&P 500, right? So like S&P 500 gets 10%, they're trying to get 20% or so. But the fact of the matter is only about 40% of investment managers beat the S&P 500 every year. Like these are like professionals making millions of dollars. This is their job.
This is their life.
This is their livelihood.
It's been their lives.
It's
They've been doing this. They know everything. Like it's safe to say they know a lot more than you do as a beginner investor.
Exactly. And their job is to beat that. And over 60% or about 60% of them can't.
Yeah. Which is crazy.
Which is absolutely insane.
Like imagine an MLB pitcher getting hit home runs off of 60% of the time. That's basically that's how hard it is.
Yeah. Yeah. It's a really hard task. I'm sure they're doing great work and all, but that's that. But so like literally, so what I'm basically trying to say is like, I would put like investing is also like put your money in the market as well, right? And like try to get a greater return than just the 5.5%
or the 0% even.
Exactly.
Because on average it goes up.
Yes, on average it will.
Sometimes you may lose, but like most of the time it goes up.
Exactly. So I think that's the differences between savings versus investing. Okay. I would say.
Interesting.
That's what I got there.
And so I guess once you figured that out, you figured out that I wanted my money to grow in order to, I don't know if you touched on it, but like to beat inflation is kind of the goal of investing. But I don't know if we need to go there. Yeah, I would just bring it back a little bit, a little more simpler. Like if people are wondering, okay, I've figured out saving versus investing, when should I implement this? I have my money in a savings account. Should I put all of it in the market right now? Should I put some of it in? Should I like wait for a drop? Like when should you start doing
When should you start? I'd say like now. Like not right like now. not like this like
get my phone out.
Not like in because of the market this is the perfect time, but like just because like as you get money, I almost think is like that's when you should start doing it. Like you shouldn't overthink, you shouldn't do any of that. It's literally like to start just start
as soon as possible.
Like get your ass in gear and start going. Like because you mentioned a pretty big thing there is like inflation, right? So this thing people talk about, it's like inflation, right? And they always say, oh, inflation is about 2% every single year.
Well, let's say inflation, if you don't know, is like basically your purchasing power. Like it's how much your money can get you, and it kind of decreases.
Yeah.
It's like the Model T in whatever year it came out was $800. Now a car is like $30,000. So that's sort of like inflation is doing that to your money.
Exactly. Yeah. Exactly. So like, and an even better example is every year this happens. And people will say it's like a 2% inflation. So let's say something was worth $100 today. Next year it might be worth $102. And really the point is that adds up and builds over time. And all of a sudden that 2% means a lot. But I would actually say even worse is like that's why people actually call like inflation it's like a tax on people because like you're losing 2%. Like you got paid, and if you don't have something invested, you actually lost money because it inflated. Now it's worth 2% less.
Yeah.
So I definitely agree with that. But I think it's worse than people actually realize, because I actually think if you're keeping up with like the 2%. You're actually still being left behind almost. Like you are still losing money.
Really?
Because I would say this is So there's something called like, this might be too complicated. Let me know if it is. There's like M2, which is just the money supply. It's how much money is in the market or in the world.
How many actual dollars?
Like how many like literal dollars exactly have been created, right? And that grows closer to about 6% every year.
Oh.
So every year, the amount of money
in circulation
grows about 6%. Then you have the S&P 500 grows about 10% every year. People who own houses, those grow.
Whatever.
It might be about 6% a year, but sometimes better than others. But same thing. So really, the thing is all of that is really just inflation.
Yeah.
And if you don't have your money invested, then you're losing out on that completely. So you're really, if you're not invested, like you're not just losing the 2% in terms of inflation, you're losing the S&P's return that year. You're losing tech's return that year. But if you want to be in Bitcoin, you're losing their return that year. Yeah. You're losing all of the return. And so you're really just taxing yourself. I would honestly say you're being left behind. Like you just have to have your money in. And so when you say when is the right time, it's now. Like you don't want to waste your time.
Stop the bleeding that's already happening.
Right, because if you like talk to a billionaire, millionaire, that maybe they have like a small portion of their money in like a traditional savings account. 98% of their money is out there making more money.
Yeah, and
so if you're not matching what those people are doing, then it's bad, and you just want to start compounding that earlier. Because like basically the way compounding works is the quicker your money's in, the quicker it starts compounding. On itself.
You get a bigger sum, you get a bigger return on the bigger sum, bigger return.
Exactly.
Yeah. So Ricci, say there's a person with $100 and another person with like $100,000. How much should each of these people be investing? And like, does it matter how much they have, how much they should put in?
Yeah, I would say like they should each be putting in as much as possible, but what each person can be putting in, it's going to basically be almost a percentage, right? So I almost think of it as like you're investing what you can afford, which is very different than what you can afford to lose, right? You should be thinking of investing as I'm going to lose all this money. It's much more about this is a growth of my wealth, right? So it's what you can afford. I honestly think it's going to be different for person to person. Is like it's almost like building a budget, almost like this is how much I'm spending every week, and then after all these expenses, I want like a small portion left over. Okay, sure, like a little safety fund or go at it. It's going to be different for every person, and then whatever's left over, that's how much you should be putting in. And it's going to be different for literally everybody, right?
Yeah.
But like, I think really though, the biggest part is the budgeting. Like when I was like doing, basically what happened was
life stories with Ricci.
Life stories with Ricci. Here we are. So basically out of college, right? I had all the debt.
Yeah.
Crazy amount of debt.
Crazy.
I don't know. Just like everybody who graduates, right? And then there was public debt, and then there was private debt. Private debt is about a 9% interest rate, 8 to 9% interest rate.
Yeah.
That is like crippling, okay? Because like the way you have to like think about like a debt payment is essentially like if you're not making more than like compounding your growth. So, okay, let's just make this simple. Your debt has a 9% interest rate. If you're on the market making more than 10% a year, then basically anything under 9%, you lost money.
Yeah.
Essentially, like you should be paying off the debt. Does that make sense?
Yeah.
Right? If you make more than 10%, then really you only made 1% because it's 10 minus the 9.
Yeah.
Okay. So basically, I saw the debt as an opportunity to make a guaranteed 9%. As any time I paid it like over the minimum payment, like I paid down the principal. It was a 9% return every single time. So if I did $1,000, 9% of $1,000 was like a $90 essentially. So like that payment made me $90, right? So, but while I was doing that, like I was basically living off of like peanut butter and jellies.
Yeah.
like legitimate peanut butter and jelly. It was my grandfather's basement. Literally.
Just reaching grinding.
Yeah, I was in his basement, so I had no rent. And then I was just
Eating PB&J.
I was eating PB&Js. They actually call me PB&J kid. Like, Ryan, what do you have for lunch? And I was like, PB&J. They're like, dude, that's cute. They could like call me like the little kid. So funny. I deserved it.
Hilarious.
It was hilarious. Look at me now.
Very funny guy.
Look at me now. Right. But all that money, and I'd be left with literally $100. But anything over the $100, I literally put all into private loans.
Yeah.
And I got it down within a year because it was 98%. It was 95% of my paycheck was going straight into the private loans. I was able. It was a year and a half or so.
Look at that.
Right. And so that's how I would do budgeting, is like, how much
can I literally force into these loans while still surviving?
Yeah. And I would honestly say loans are like the biggest things you do not want.
No, definitely.
Like it basically goes like credits, like in terms of really bad, like a credit score is a credit card the credit card debt probably has a rate of like 31%.
As in like not paying off your full bill and then it rolling over and you having to pay interest on that.
Yeah. Yes. And that's like a 31% interest rate.
Yeah.
You're not going to
Holy what?
You're not going to get a 30% return in the market.
Sorry.
Hate to break it to you, right? So that's the first thing. Like if you have credit card debt, you got to get it out like immediately, because you will not be able to compound your wealth at all.
It'll destroy you.
It will absolutely destroy you and cripple you. So that's probably the largest one. Then it's probably the private student loans. If I had to guess, they're around the 9% range. Car payment, what is that, like 7%?
It was around 7.
It's about 7%. So that's the next one. Like I don't know. I kind of have small thoughts on car payments, but I'll just give you the honest thoughts is like, if you can't buy the car in cash, you probably shouldn't have it, because what happens is you're buying a depreciating asset with a loan. So what happens is the value of your car, the second you drive it off,
a lot,
it goes down by 50%.
Yeah.
So now when you try to sell your car, it's worth 50% less, probably more. So you want to get a loan on something that's going up in value. So like a house would make sense to have a loan. I mean, it would be nice to not have a payment on your house, but it's probably unlikely that that'll happen for anybody in our generation. So yeah, that's my thoughts on the car. Is literally like, you shouldn't have a car loan. Like
beater.
You should literally buy a beater, and then your investment account, maybe over time you're saving and saving. And now you can afford like a little bit better than a beater.
Yeah.
So that's the next loan, which is about the 7% range. Then you have mortgages, which are like, okay, like a mortgage payment's massive.
Yeah.
But at least you're appreciating in value.
Right.
Those are about, I don't know, probably about 5 to 6% range, or like for the people for older generations, 3%, in which case that's amazing.
Yeah.
And then the last one would be your public student debt.
Yeah.
And so that's probably about 2 to 4%, probably closer to 3%. Kind of what I think about with that is, okay, I can make in the market more than 3%.
Yeah.
And just as we talked about at the beginning of the show, that's your like risk-free rate. Your risk-free rate right now is about 4 to 5%. That's still higher than the 3%.
Yeah.
So as long as I have that money in that account, I'm netting 2%.
You're good.
So I'm almost like making a little bit of money by not paying it off. Right, but that's a 3%, okay? That's a 3% loan versus like you have to tackle the biggest loans first and get those high ones out of your life.
They'll bleed you.
They will bleed you, because like instead of being able to put in $1,000 a month, I'm only putting in $20 a month.
Yeah.
And like it's a lot less, because again, if we did the compounding exercise, the quicker you start putting in the most amount of money, the more beneficial it is to you, because it's going to compound earlier. So you want to start the compounding as early as possible.
Yeah.
But you can't start compounding if you have loans.
No.
And so that's how I'd answer the question of how much is literally how much can you live off of? What's the minimum amount you can live off of, and live off of that, and then put the rest in. And then maybe you can have like a small little pile if you want. I don't have one of those. Drives my wife crazy. But I'm like, I don't know. Who cares? Not who cares, but I'm a risk taker in life. I don't know. I go backpacking in weird places, and yeah, it's a problem.
You are a risk taker.
I was born for chances. We have a saying in our family. It's called "Ricks are born for chances," and I definitely live that out. Like I'm definitely born for chances. But anyway,
let's go.
This podcast is not about chances. It's about helping you.
Yeah, it's about diligent investing.
Diligent investing,
not lottery tickets.
Not lottery tickets. Exactly. So that's how I'd answer that question as much as you can.
As much as you can. As early as you can.
Knock out. Yes. Yeah, and knock out the services like Netflix, monthly payments.
Ah, yes.
No, people do not realize how much they're spending on monthly payments.
It's probably way more than you actually think.
Way more.
Way more.
Let's say you have a monthly payment that's $100, a subscription to anywhere. Over 12 months, that's actually
$100. What's $100?
A gym membership.
Oh yeah, really good point.
I guess
go
people like going.
Go do some push-ups.
Actually, that's what I was doing. But no, like really, the point is like $100 subscription is what, $12,000?
Yep.
Mental math.
A year. No, wait.
Is 1,200? $1,200.
Yes.
Okay, but those add up.
That's a lot.
It's still it adds up a lot, and so that's really bad. So like if you have like Hulu, Netflix,
right,
all of that,
Paramount, HBO Max, Hulu, Netflix,
add Spotify to that,
and Spotify and Stars. Like, how much TV can you watch? Just pick one.
Right, but like those monthly, you're like, oh, it's only like $3 a month, but then all of a sudden you have 10 of them, and then all of a sudden you're actually paying close to $12,000 a year on something, and then it's like, oh my goodness. So I would just say, like, try it. Get into your parents' one. Just don't let them know. But yeah, try to cut out those too.
Try to cut out all recurring expenses that you have and put as much as you can into the market as early as you can.
Exactly. Like any monthly payment, that's payments that can go into the market, and then you can buy nicer things maybe in the future.
Yeah, in the future. But I mean, it's lost on us now. What are we gonna buy that's super nice? You want it when you're a little older, more refined.
Yeah, imagine a bigger house.
Right. Do you want a bigger house, or do you want to watch 9 subscription services at once? A bigger house.
Bigger house, for
right?
Sure.
That's what I would choose.
Yeah, I would choose that too.
Yeah,
that could be that. Well done there, and that was good.
Thank you, Ryan. So we know the difference between saving and investing. We know when you should start investing. Now, when you are investing, you want to, obviously you think it's like a casino. You think you're going to become rich overnight. What are some mistakes you see that beginner investors making, maybe trying to, maximize their returns really quickly and not having good patience or just what are some things you see or some advice you could give to how people should start out with investing?
Yeah, so I guess the biggest mistake would be not knowing how much that they should be putting in, and or just not investing enough, right? Because that dovetails off the earlier point, right? Of you need a compound, otherwise, because everything that's not making money is actually losing money, right? Yep. So if you're not putting in and really maximizing yourself, you're losing. You're losing, right? So I would say the biggest mistake, one, is not doing enough. The second biggest mistake is overthinking it, because I think everybody's like, I don't know. You can go online and you can just talk, like you go online, you can just Google should I buy Nvidia. You're gonna have 20 million different people having suggestions on if you should or should not buy Nvidia, and then even worse is like, and so then they're like, okay, I don't know, right? And then they just start overthinking it and like making it way, way too complicated. Yeah. Where like, again, like I said at the beginning of the show, if 60% of the people can't beat the S&P 500.
Yeah. What makes you think you will?
What makes you think you will? Why like, if you're not doing this every single day. For years, 30 years, right? Like you're not. It's unlikely you're going to.
You may get lucky once, but you won't get lucky over time. And investing is all about over time.
Exactly.
It's about consistency over time.
Exactly. Like you're not going to make a lot of money like tomorrow. Like you're not gonna put your money in all, and then tomorrow it's gonna be 100% more.
Right.
It literally doesn't happen. Like it's honestly it's the worst, but it's not the worst. It's the best. It's just this slow growth.
Yeah.
And over time it goes up. So like literally just like stop overthinking it. If you like find yourself you're overthinking and so forth, just put in the S&P 500 or just like do something. Now you could diversify. Diversify is good. And it's a good thing. Maybe we can talk about like maybe the next episode about what diversification is, where you can look.
Yeah, like how to allocate, how to split it up.
Right.
That's a separate thing. It is a good idea. It's smart
But
to do
to
protect yourself to downside. But we'll get into that next time.
We can do that next episode. But like just literally just stop overthinking and just get your ass in gear and just start.
Yeah.
That's a huge mistake. And then the last mistake is just that they end up never starting because they get too overwhelmed by all the things.
Yeah.
So like
there's a trillion things to look at. There's all these places trying to get your attention, even more so now than in the past, obviously with social media, all the 24/7 news cycles going on. Like you can kind of block most of it out is what you're saying, I think.
Yeah, I think that's exactly what I'm saying. It's like block it all out. Just understand each vehicle that you're putting your money into. Understand that some are riskier than others. And you don't have to be a genius to figure out which ones are riskier than others. It's very like tech is a little bit more riskier than the S&P 500. S&P 500 is a little bit more riskier than a bond. Bond is a little bit more riskier than the risk-free rate.
Right.
That's really all you need. You really need, and then it's just get it going. Just start, like block out the noise, and just really start.
I guess just one more bonus question. I know you mentioned risk right there at the end, and I'd kind of like to know what's a time to take risk. Like we talked about, you just get into investing. Maybe you've been doing it for a while, and I know people say that if you're younger, you want to take more risk, kind of maximize your return. What's your thought on that? Because I know you were talking about just put your money in the market, basically.
Yeah, I totally agree. Like when you're younger, like here's why they say it, because somebody that's going to retire in 10 years or so, let's say, so that you output you at like 56, probably 60 nowadays. You're 6 years old, right?
Probably.
Right. And so if you lose 20% of your money, that's even if it's $1 million and you lose 20%, right? All of a sudden now you have to work like 2 to 3 more years to get towards entire retirement.
Yeah.
And so that's why people, but if you're younger, since you have so much more time, like I'm not trying to retire tomorrow.
Time to recover.
You have a little bit more time to recover.
Yeah.
That's why people say that. And I would also agree is like, I'm also just a riskier person in general, probably also because of my age.
You are. Yeah, good point.
Right. But like for like people like us, like it almost does make a little bit more sense to be in like something like Bitcoin. I like Bitcoin's even more riskier than tech.
Could have more upside than anyone can imagine. Could have no use, but at least you tried, right? And you can recover that.
Right. But I wouldn't put 100% of my money in Bitcoin,
no.
right? Because it's risk. And really what risk is like, yeah, you can make a lot, but you can also lose a lot.
Yeah.
And so like at the most latest drawdown, let's say like the last, like I guess recessionary type of period, like the S&P was down 20%. Okay. Bitcoin was down 80%. Yeah. Right. And then if you go towards those meme coins,
oh my God,
those were down like 99%, 100%. So now whatever you put in, it doesn't exist.
It's gone.
Right. So that's what that risk curve is. But that's why you're not putting 100% of your money in the meme coins, right? Like I know you like see these stories, oh, they made XYZ and then now they're millionaires. Well, like they're more lucky than anything, and it probably also doesn't even exist.
Yeah.
Is really the thing. Like you have to like
it's like gambling.
It's legitimate gambling. Like you have people who win the lottery, but also how many of those people who win the lottery are not broke? Right. I believe the stats like
probably a lot.
I think it's close to 80%. That's a Google for another time because we learned anyway. So like that's what I would say in terms of the risk is like when you're younger you're allowed to take a little bit more risk, and you can take more risk. Just understand what you're investing in and that it is risky, and that like putting all your eggs in one basket like is not the smartest play, because it could not work out for you. It could work out for you, but that's probably a low probability. Like, you're not trying to make all your money tomorrow.
No.
It's a grind.
I agree. All right, Ryan, that was a great episode. Next week we'll talk more about diversification of your portfolio, avoiding risk, how to, also maybe make riskier bets in a smaller size, while having a more complete investment portfolio. But, that's for next time. So listeners, write in if you have any questions you want us to go over. We'll try to answer them in the next episode. But good job, Ricci. That was fun.
It's always a pleasure with you, Sir Perko.
Absolutely.
And you can also send the questions via Twitter too.
Yes.
So just send them. My Twitter handle is Hedgeye, HEDGEYEAI.
Yes.
Hedgeye is spelled right there, actually, all the way up there. So yeah, you can. It's also spelled right there. Look at that. Anyway, so yeah, send in your questions. We look forward to answering all your questions. And thank you.